Hello and welcome to our discussion on the cash flows. Today's session will try to determine the cash flows when the balance sheet and income statement are given. We know that the change in a balance sheet, two balance sheets, can be explained by the cash flow statement and income statement. So when the two balance sheets are given, opening balance sheet and closing balance sheets are given, along with the income statement, it is possible to find the cash flow statement. So in this session, we will first try to prepare the cash flow statement by showing the receipts and payments. Then we'll slowly understand the different cash flows. So when the opening balance sheet and in the closing balance sheet and income statement given, we can determine the cash flow statement by either taking an individual item by item from the income statement or the balance sheet. So in this session, let us start with the income statement items. So sales is the opening cash in hand is 55,000. The sales is 100,000 and there is a debtor of 70,170. So collection is equal to opening debtors plus sales minus the closing debtor is the collection. So that means during this period the company has not collected any cash. Opening debtors plus sales minus closing debtor, and there is no bad debts or discount, so the collection is 0. The cost of goods sold is a part of the stock which we'll take up when we calculate the cash flows indirectly. Salaries, during the period salaries is 10,000. There is no outstanding salary, so therefore entire salary has been paid. Rent, the rent in the income statement shows 12,000, but there is an advance rent of 12,000. So the rent paid during the period is 12,000 plus 12,000 is a rent paid. Interest, income statement shows an interest of 8,000 and the balance sheet shows that outstanding interest is 8,000. So entire interest remained as an outstanding, so no cash flows for interest. Tax, depreciation is a non-cash item. It will not affect the cash flow statement. The tax is 10,500 and the balance sheet shows that there is no outstanding tax. So we will take the cash flow into the cash flow statement 10,500. So the total cash inflow is 55,000. That is only the opening cash in hand, and outflows are 44,500. So cash in hand at the end of the balance sheet period is 10,500, which is given in the balance sheet. So when the balance sheet is given, it is possible to find the cash flow statement if income statement and closing balance sheets are also given. So no change in the capital, no change in the loan, no change in the creditor, no change in the plant has changed only because of depreciation, which is a non-cash item. Now let us use this cash flow statement to understand the different cash flows as per the business decisions, which according to the accounting standard are called cash from operation, cash from financing decisions, and cash from investment decisions. Cash from operation is all inflows from operating activities, so sales minus all outflows from the operating activities, that is salary minus rent, and we also treat the taxes and tax as the operating decision, and we treat interest as a non-operating or it's a financing decision. So cash from operation is 44,500. Cash from investment, there is no inflow from investment and no outflow from investment. So cash from investment is 0. There is no cash from financing. There is no raising of capital, no raising of loans, and interest also has not been paid. So cash from financing is 0. So in this question, the cash from operation is 44,000 negative. So the cash in hand reduced from 55,000 to 10,500. But observe this, PAT is 24,500, whereas cash in hand, the cash in hand is 10,500. So cash in hand and PAT are not same, but at the same time cash in hand is also not, at the same time the cash from operation is not same from PAT. So we would like to understand why the cash from operation is not same as profit after tax. So let us find that by doing an indirect method of preparing the cash flow statement. So cash from operation is not same as PAT due to the following reasons. The cash from operation is not same as PAT due to the non-cash items like depreciation, amortization. Cash from operation is not same as PAT due to non-operating items like interest received, dividend received, interest paid. And cash from operation is not same as PAT due to the credit item, which can be determined by seeing the changes in the operating working capital, creditors, debtors, stock, advance rent. So let us see in this question how is and why is a CFO not same as PAT. So depreciation is a non-cash item, we add back. Interest is a non-operating item, we add back. The working capital changes, the creditors have not changed, so no change in the creditor. The debtors have increased, you can see that, so that means we sold the goods on credit, so negative, it has to be reduced, because while taking the income statement we have shown entire sales as income, but we have not received the sales, so therefore entire sales is a credit sales here, so deduct. Stock has decreased, that means the previous time period stock has been used as a COGS, so there is no cash flow outflow in this time period, so entire COGS or change in the stock is added back. The advance rent here, there was no advance rent in the beginning, but at the end there is an advance rent, and then we paid advance rent, so it's an outflow of cash which is not shown in the income statement, because income statement only records the current rent. So if you sum this up, we should get the cash from operation as negative. So cash from operation is negative in this case because of depreciation, because of interest, non-cash and non-operating, and because of the changes in our working capital. The largest item is the change in the debtor. Debtor has decreased, so therefore it means a credit sales. Debtors, the stock, the previous time period stock we have used in the current period, and we paid a rent in advance. So because of these non-operating, non-cash and credit item, the PAT is not same as CFO. Thank you very much.